Welcome to our deep dive on the so-called Roth IRA withdrawal hack. You may have heard that you can pull cash from your Roth IRA anytime without taxes or penalties. That is partly true, but it comes with major strings attached. In this video, we will explain exactly what you can and cannot do, the hidden rules that can trigger taxes and penalties, when Form 8606 matters, how Roth IRA rules differ from Roth 401k, the 5-year clocks, and the long-term wealth destruction that happens when you treat retirement accounts like an ATM. We will also include a quiz and step-by-step alternatives so you can protect your future self. Let's begin, and then transition into the agenda so you know what to expect. Here is our roadmap. First, we will clarify what the withdrawal hack actually is. Next, we will cover the crucial distinctions and hidden rules that determine whether your withdrawal is tax-free or not. Then, we will show how to correctly document distributions on Form 8606 to avoid unnecessary taxes. After that, we will compare Roth IRA with Roth 401k access rules. We will explain the two 5-year clocks that trip people up. Then we will quantify the long-term cost of taking contributions out. We will finish with better alternatives and a short quiz. To set expectations properly, let's insert a quick disclaimer before we dig in. This content is educational. It is not tax, legal, or investment advice. Everyone's situation is different and tax laws change. Before taking action, consult a qualified professional who can review your personal facts. With that clear, let's move into a quick refresher on what a Roth IRA is. A Roth IRA is funded with after-tax dollars. The big appeal is tax-free growth and tax-free qualified withdrawals later in life. Critically, your direct contributions, also called basis, can generally be withdrawn at any time without tax or penalty. But earnings are different and subject to rules. To understand the so-called hack, we need to see the decision path. Let's map it out visually, and then elaborate. The hack relies on the fact that the IRS allows you to remove your direct Roth IRA contributions at any time without additional tax or the early withdrawal penalty. However, once you move beyond contributions and touch earnings, you can be exposed to ordinary income tax and a 10% penalty if you are under age 59.5, and the 5-year requirement for qualified distributions is not met. Therefore, the first question is always whether you are withdrawing contributions or earnings. If it is contributions, access is straightforward. If it is earnings, the rules get complicated. With that in mind, let's spell out the hidden rules that commonly trip people up. Here are the 4 key rules. First, only your Roth IRA contribution basis is freely accessible. Any withdrawal that dips into earnings before qualifying events can be taxable and may include a 10% penalty. Second, reporting matters. You should use Form 8606, specifically Part 3, to show that your distribution came from after-tax basis and is not taxable. Third, Roth 401k plans do not offer the same liquidity as Roth IRAs. Contributions and earnings are commingled in plan record-keeping, making it impractical to isolate contributions until you separate from service and roll to a Roth IRA. Fourth, converted amounts from a traditional IRA, such as from a backdoor Roth, must generally remain in the Roth for 5 tax years before you can withdraw those converted principal dollars without penalty, even though they were already taxed. Next, let's put Roth IRA and Roth 401k side by side for clarity. This table highlights the practical differences. In a Roth IRA, contributions are generally accessible. In a Roth 401k, access to contributions is not typically separated from earnings in a way that allows selective withdrawals, especially while you are still employed. Earnings in both accounts require qualified distribution status to be tax-free. Both account types have 5-year rules, but the administrative experience differs. For Roth IRA distributions, you use Form 8606 to calculate the taxable portion, whereas in a Roth 401k, you are governed by plan rules and reported on the Form 1099-R the plan issues. Next, let's look closely at the Form 8606 reporting so you avoid avoidable tax. When you take a distribution from a Roth IRA, the custodian will issue a Form 1099-R. To ensure the IRS does not treat your basis distribution as taxable, you should complete Form 8606, specifically Part 3, which reconciles Roth IRA distributions, determines whether any portion is taxable, and confirms your ordering rules. You will need your records of contributions and conversions to correctly complete the form. Tax software typically handles this, but you must still supply accurate inputs. Skipping this step increases the risk that the IRS treats your distribution as taxable when it should not be. Now, one of the most confusing areas is the 5-year timing rules. Let's visualize those next. This timeline illustrates two simultaneous clocks. The first clock governs whether earnings come out tax-free. It starts on January 1st of the year you first funded any Roth IRA and requires at least 5 tax years to pass, and that you meet a qualifying event, such as reaching age 59.5, disability, death, or a first-time home purchase up to $10,000. Only when both timing and qualifying conditions are satisfied are earnings tax-free. The second clock applies to each conversion from a traditional IRA to a Roth IRA. Each conversion has its own 5 tax-year waiting period before you can withdraw the converted principal without incurring the 10% early withdrawal penalty. Taxes on the conversion were already paid, so the clock is only about the penalty, not income tax. These clocks run at the same time, but they are distinct. As we move forward, let's test your understanding with a quick quiz. Quiz time. Which amount can you generally withdraw from a Roth IRA at any time without taxes or the 10% penalty? A. Your direct contributions, also called basis. B. All investment earnings. C. Any converted amount within 5 years. D. Employer match inside a Roth 401k. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Your direct Roth IRA contributions are generally accessible at any time without tax or penalty. Earnings are not freely accessible unless conditions for a qualified distribution are met, and recent conversions are subject to their own 5-year penalty clock. Employer match occurs only on the 401k side and is governed by plan and tax rules, not the Roth IRA contribution access rule. Now that we have confirmed the basics, let's compare using a Roth as an emergency fund versus keeping a traditional emergency fund. On the left is a dedicated emergency fund. It targets 3 to 6 months of expenses, lives in a high-yield savings account, offers immediate liquidity, involves no tax forms or penalties, and protects your retirement accounts. On the right is using a Roth IRA as an emergency fund. It requires precise tracking of contribution basis and careful Form 8606 reporting. There is a risk of accidentally withdrawing earnings if records are incomplete. Withdrawing contributions destroys Roth contribution space that cannot be recovered. If errors occur, taxes and penalties can apply. With that context, let's quantify what the forever loss looks like when you pull contributions early. Consider withdrawing $6,000 at age 30. Had you left it invested at a 7% annual return for 30 years, it could have grown to roughly $45,674. Approximately $6,000 is your original contribution, and about $39,674 is growth. In a Roth IRA, that future growth could have been entirely tax-free if withdrawn as a qualified distribution. When you withdraw contributions today, you not only lose the immediate $6,000, you also lose the decades of tax-free compounding and the contribution space for that year, which you cannot retroactively restore. Now that we have seen the cost, let's walk through smarter steps you can take instead. First, create a dedicated emergency fund with 3 to 6 months of living expenses in a high-yield savings account. Second, automate contributions into that savings account immediately after payday to reduce friction and maintain discipline. Third, segregate goals. Use a taxable brokerage account for medium-term goals and keep the Roth IRA strictly for retirement. Fourth, invest inside your Roth according to a long-term policy allocation and avoid treating it as a cash reserve. Fifth, if you have no choice but to withdraw, keep precise basis records and ensure you file Form 8606 Part 3 so the IRS recognizes the distribution as non-taxable basis. Next, let's cover a few edge cases and exceptions so you know the boundaries. For earnings to be tax-free, a distribution must be qualified. That generally requires that your 5-year clock for Roth IRA contributions has elapsed and that you meet a qualifying event such as reaching age 59.5, disability, death, or a first-time home purchase up to $10,000. There are penalty exceptions that can waive the 10% penalty, but do not necessarily eliminate income tax on earnings. These include qualified higher education expenses, certain unreimbursed medical expenses, health insurance premiums while unemployed, and the birth or adoption distribution up to $5,000, among others. Remember, conversions have their own 5-year penalty clocks, distinct from the earnings 5-year clock. Finally, note that Roth 401k plans typically restrict in-service withdrawals and do not isolate contributions from earnings. Rolling to a Roth IRA after leaving your employer can change the access rules. Before wrapping up, let's crystallize the big takeaways. These are the essential points. Contributions can be accessed. Earnings generally cannot unless the distribution is qualified. Properly filing Form 8606 Part 3 is critical when you take Roth IRA distributions. Do not confuse Roth IRA access with Roth 401k access. Each conversion has its own 5-year penalty clock. Above all, using the Roth as an emergency fund sacrifices tax-free compounding and permanently loses contribution space. In summary, while you can withdraw Roth IRA contributions at any time, the long-term cost is significant due to lost tax-free compounding and permanently lost contribution space. The wiser approach is to preserve your Roth for retirement, build a proper emergency fund, and maintain meticulous records and correct tax reporting if you ever must take a distribution. Finally, let's end with a quick diagrammatic recap. This final flowchart reinforces the decision path and the need to differentiate contributions, earnings, and conversions. It also reminds you that Roth 401k access rules differ from Roth IRA rules and that separate 5-year clocks exist. Above all, maintain a real emergency fund to avoid tapping your Roth. As we close, we have a quick call to action. Thank you for watching. If this helped you avoid a costly mistake, please like the video, share it with someone who might need it, and subscribe for more clear, practical guides. Post your questions or scenarios in the comments because we read every single one, and your question may become our next video. See you next time.